special conversation where we speak to experts who explain concepts and strategies of investing in the market. Today, we will touch upon multi-asset funds. What are they? Who are they for? What are the risks associated with them? I'm Maloni Bhatt, and I'm very happy to welcome my guests today. Chirag Mehta is the Chief Investment Officer of Quantum Asset Management. Chirag, welcome again.
Thank you, Maloni. Thank you for having me.
Good to see you. And Gaurav, welcome to Economic Times. You're the founder and CEO of Kuvera, an online wealth management platform.
Thanks, Maloni. Happy to be here.
All right. We're very happy to have the two of you. Gaurav, I'd like to start with you. 2023 is predicted to be a slow year for growth the world over. The IMF says 9 out of the top 10 advanced economies will likely decelerate, and as will India, but the IMF says it is a bright spot. Now, what's your view on the Indian economy? We've just had the budget. And of course, what's your view on the market? And what's the advice that you are offering investors at this point?
So I'll start from the start, right? I think we are not in the business of making predictions. If you think about what is going on in the Indian economy, structurally, the economy is in a good space. Government investment is picking up, infrastructure investment is picking up. Demographics had always been our strong suit. The problem was we didn't have the support structures to actually start, getting the dividends of this younger demographic. This decade, it looks like, at least institutions and policies falling in place to kind of enable it. So the long-term view is that Indian economy is going to do well, Indian businesses are going to do well, Indian stock market is going to do well. What happens year to year, my guess is as good as anyone else's. It's really hard to say that. I mean, a lot of IMF and I'm pretty sure they are incredibly bright people, but I think they predict because they have to put a number somewhere, so they put a number. But when I look at these predictions, I actually I put more value on the relative ordering than the absolute numbers. Absolute numbers have a lot more volatility. If you even look at previous predictions, China will grow at this rate, that rate, the numbers will all over the place. But everyone said for the last 15 years, China will be the fastest growing economy, which is largely held to be true. So I think the relative ordering is definitely correct. What we are advising our clients, we have a very retail audience, right? And I think our focus always is to kind of make them less trigger happy than all the trading and broking platforms would want them to be. So our advice always is look at your asset allocation, look at your goals, rebalance periodically, and to be very honest, become the best in your day job. Because if you really want to get rich, it starts by having a very large income. You only invest what you save. So don't spend too much time in trying to pick sectors or stocks or time the markets. Stick with your goals, stick with your asset allocation, and just enjoy the ride.
And some of these themes we will touch upon, especially asset allocation, that you spoke of. Chirag, the last time when we spoke, you said that in 2023, value style investing will make a comeback, large caps, auto IT financials will do well. And you advocated an asset management approach. The budget is out now. You're sticking with what you said earlier. Is there anything that you'd like to add?
No, I think the budget only furthers what we said. I think reinforces the point that, we are well poised, as like Gaurav said, Indian economy is in a sweet spot. We are in an economic upcycle. The capex push furthers that, and therefore it's all about the capex revival story that we were looking at, which is going to be the driver for the Indian economy. So I think nothing changes from that perspective. If you look at most of the asset classes, they are well poised. The yields have moved up significantly. Equity markets, we'll see as economy grows, earnings pick up. What was unlike from 2015 to 2019, where earnings growth was a missing part, this time we are seeing good earnings growth in the economy and a lot of activity at the ground level, which suggests that even Indian equities are in a better spot. 2022 also taught us that gold is that diversifier that also helps you in your portfolio. So all three asset classes, none of them are extremes, looking more constructive. So from that perspective, I think an asset allocation strategy will augur well for investors, which I kind of also takes into consideration that global economic shocks, even if they impact Indian economy, there'll be lesser impact from a risk perspective and well geared to get more returns or optimal returns from your portfolio. So I think it's a great year to be asset allocated in the right manner.
All right. So the focus on asset allocation, minimize your risk, and try and get the optimal returns is what you're focusing on. Gaurav, for the purposes of this conversation, we're talking about multi-asset strategies. Could you explain what this means? What are the most common forms of multi-asset strategies, and what are the benefits of these?
It's a very simple concept. It goes back to the saying that don't put all your eggs in the same basket, and that's what an asset allocation strategy is. Simply put, there are to any individual, to any retail household, you have surplus income, you have surplus savings. You have a choice to make, right? Do you want to put it in the equity markets? So that's stocks, mutual funds, ETFs, stocks. That's up to you. But equity as a whole is one asset class. You can put it into debt. So that starts from gilt, which is the government loans, all the way to corporate borrowing. You can do an FD. You can put it in real estate. You can invest it in real assets like real estate or gold, right? So broadly speaking, for a retail household, these are your choices, right? Now, there's a decision that needs to be made. The decision is how much do you put in which asset class? And that's the genesis of multi-asset thought. The reason why it is so popular is that none of these asset classes does well all the time, right? So when real estate was booming early 2000s, maybe equity didn't catch up or didn't do as well. 2012 to 2000 till now, real estate is not doing that well. If you look at gold, 2008 market crashed, gold actually did really, really well, right? So these asset classes also move, are uncorrelated to each other, so they don't move in lockstep, which actually helps the investor. The way it helps the investor is not that it kind of maximizes returns, but it keeps the investor invested in that asset class or in that basket of assets for a longer time. I mean, a simple thought experiment is if you're 100% in equity and the market crashes 40%, it'll be only the very kind of seasoned investors or the seasoned retail households who will say that, oh, we have seen multiple such cycles, time to double down. Most people will actually panic and run away. But if you were only 50% in stocks and 25% was in gold, that gold will go up probably 40% if the stock market is falling, crashing 40%. And so effectively on a portfolio level, you will probably be down only 10 or 11%. A much easier hit back for a household to take and to continue investing. And what we also talk about, kind of what ties this all together, is you do multi-asset because it helps you stay invested for longer. And the ultimate goal is to be staying invested for longer, because compounding happens over time. You can't invest more and kind of just have higher returns the same year. So this is the kind of, simply put, why a multi-asset portfolio is completely important.
And how do investors then decide that within a certain portfolio, within their portfolio, they're going to give a certain amount of weightage to equities, certain amount to debt, certain amount to gold, for instance? How do they make those choices?
It's a very interesting question. It's the question that probably no one has a clear answer to. But people use rule of thumbs, right? I think an equal weighted portfolio is the first rule of thumb. If you know nothing, just equal weight everything, right? It won't do. I mean, it's actually a pretty decent strategy, right? Like historically also, an equal weighted portfolio across stocks, bonds, and gold will actually do fairly well, right? If you want to be more complicated than that, the question you should ask is, are you the right person making that decision, right? I mean, when you are sick, you go to a doctor. When you have a tax problem, you go to a CA. If this is not your day job, and if investing is not your day job, then the question is not about whether it's hard or whether it's easy. The question is that, are you the right person who has that history, who has that expertise to be able to make these calls? So if you're doing an equal weighted portfolio, by all means, do it yourself. If you're doing anything more complicated than that, and you have convinced yourself that, you've done the work, you understand the macro, you understand kind of, all the things that affect security prices, then follow your strategy. And by all means, just stick to it. Don't get sidetracked. Don't change it too often. Otherwise, mutual funds, ETFs are a very good option. Leave it to the professionals and let them decide, based on the changing scenarios, what are the right asset classes to be in.
Chirag, time to bring you in. How should one decide now? If Gaurav says that you're not an expert, leave it to the experts to take that call for you and go for mutual fund. But how do you then decide which is a better mutual fund? And lap to that, the question is, what are the risks associated with multi-asset strategies? If you could outline them, and how do investors identify and manage risks regardless of their size and sophistication? This is in terms of investment.
Sure, Miloni. Let me take a step back and look at the whole arena. One is either investors can choose their own asset allocation and be disciplined and invest in that strategy for a long time. Like we have been talking about 12, 20, 80 strategy. That's one way to do it. That's a DIY strategy. And one is solutions offered by mutual funds. Well, experts will say how much to put in which asset class. So there are various, like Gaurav spoke about rule of thumb, there are certain principles that allow us to ascertain which is the better asset class at this point in time that not only optimizes your return, but also looks at risk in a subtle manner. So how do you control that risk is what we kind of look at. So we have been managing a multi-asset fund, and there we kind of look at valuation as a basic principle of looking at which asset class is attractive at this point in time. So overall, that allows us to position in a manner. But again, the issue or the challenges that you spoke about with such strategies is one size fits all. You don't have, for a person who is young, may require more equities at a point in time. And that's a longer term approach that that person is taking. But here the manager is looking how are asset classes poised at this point in time. And therefore, how should it dynamically asset allocate at this point in time to take advantage of the economic cycle that we are in. So today, someone may say that equities look good over like 2-3 years. It's near the average kind of valuations. So let me be overboard equities. But that may not suit well for certain person who is towards its retirement. So overall, one has to understand that what is the product they're looking for? Is that a solution that is apt for them? And when it comes to multi-asset strategies, they could be biased. They could be biased towards one particular asset classes. So whenever anyone goes for investment, they need to ensure that it is more balanced towards asset classes, offers enough flexibility to the fund manager to maneuver. For example, there are many asset allocation strategies which have minimum allocation to equities at 65%. Even if the fund manager is convinced that equities does not make sense from a valuation perspective today, still they will be forced because of the structure to be 65% equities, and that is taking over risk on behalf of the investors. So overall, when they look at these kind of strategies, they have to ensure whether that is apt for them, whether they are truly balanced in nature, and they are not taking over risk.
Yeah, the good points, Chirag. I mean, you said that, everyone wants to take advantage of the economic cycle, but you also have to see where you're placed. So, person who is on the edge of retirement will have a different strategy, or should ideally have a different strategy, versus someone who's young and, can possibly take more risks. Gaurav, India is a young country, right? So many are turning to platforms like the one that you have, Kuvera, to invest. What are some of the insights that you can share on people's investing habits, in the last 3-4 odd years, say in 2019, 2021, versus say in the last 6 months?
See, some of the things, you would, some of the things that play out in the data are things you would expect. Some of the things, take you by surprise. At least on online platforms, one thing that is that we see, which is very positive, is a lot more women are managing their own portfolios. That number is steadily increasing. It's almost close to 30% of all our active user bases are women right now, right? And that's something that we would not have thought. Some of the things that you would expect to play out in the data, good years in equity lead to a lot more people coming in and weighing more equity in their portfolio. Largely, we see that investors stick to either an equity fund or a debt fund or gold. We don't see a lot of investors understanding the concept around multi-asset or kind of looking at the benefits of what multi-assets portfolio can do for them. People do weigh equity a lot more in their portfolio than they should. What we've seen, and this is actually very, very surprising for us also, is most portfolios are not based on an acute understanding of the investors' risk decisions, right? So a lot of portfolios we see are very barbelled. People who believe they are big risk takers will have 90 to 100% in equity, regardless of what age they are in and what life stage they are in. People who are conservative investors will have lower allocation to equity and might even have everything in fixed income and FDs. And I find this very interesting is because even though we do provide tools and most platforms provide tools where we kind of give user their risk profile, and we do it as a very very continuum form, your risk profile is this versus that. Most investors think of this as a binary outcome. Either I am risk averse or I am risk seeking. And I think that's the reason why a multi-asset approach kind of doesn't gel well with either of those groups, because the risk seeking population doesn't want to dilute that risk. And while the risk averse population doesn't want to add any risk, right? So I think the more people understand about asset allocation in general, because I think multi-asset in a very simplistic way is portfolio asset allocation within a single fund. So instead of doing portfolio, I could allocate 50% in equity, 20% in this, 30% myself in my portfolio as well, right? There are advantages and disadvantages of doing that. Multi-asset just gives me that, plus the oversight of a fund manager whose day job is to actually manage those risks.
This is all very interesting. So, you're essentially saying that despite all the data that you're providing investors, despite the education, even nudging behavior, for instance, they're still sticking to what they think they know best. And their ability to, is that accurate, Gaurav?
I don't think it's what they think, they stick to what they think is best. I think the behavioral point here is that they invest in where they believe they will stay invested for the longest time. If you do a very simple thought experiment, right? If someone believes they are very risk averse, and all the models in the world tell you that they should be 60% equity, in the first drawdown they're out. So you manage to get them invested in equity for 3 years, but then they're not investing in anything for the remaining 27 years or 20 years of their life, right? So sometimes a lot of this understanding and something that we have also realized is that people's risk behaviors change very slowly. So it has to be a very step function. You can't come in with a lot of data. You can't come in with a lot of tools and say that, hey, you know what, 30% equity is wrong for you. It should be 80%. Get it from 30 to 40, get it from 40 to 50, because they have to be able to live with that drawdown. They have to be able to live with that volatility, right? So, yeah.
All right. Chirag, do you want to come in at this point? Are you seeing the same, with firms such as yours?
Yeah, we are seeing a lot more acceptance of multi-asset strategies, specifically for people who have not been taking risk for a fairly long time, like they were parked in fixed deposits, which we all know is a losing proposition. And as they become aware about such multi-asset strategies, saying that here I take a slightly higher risk, there's no guarantee, but there is certain way where I can invest into market-linked instruments and earn a better return than the fixed deposits. So as they become more aware of this concept that there is a possibility that I could have slightly higher tolerance for risk and therefore make a higher return, that is where, that awareness is leading them towards these kind of multi-asset strategies. As they become familiar with then multi-asset strategies, markets, instruments, then they graduate towards more specific investing into equities and doing their DIY strategies per se. But I think this is a good stepping stone from someone who is very, very risk averse towards getting into market specifics and therefore investing in the right manner. Because there's still, all said and done, a lot more money parked in fixed deposits, which eventually has to move on the other side. Because we have seen, adjusted for inflation, adjusted for taxes, they have been very, very big losing propositions. And there is still a lot of money there. So I think our role is been to, get those investors. And that is how we have built the multi-asset fund that we offer. where we don't take overt risk. We are very, very well balanced into the allocations. And therefore, we tell them that look at the volatility, look at the drawdowns. And as they see proof of performance, not from a return perspective only, but from a risk perspective as well, many are convinced that this is the right way to go about investing. And we are seeing incrementally more people choose this kind of product and think twice before they invest in fixed deposits.
All right. This is now my last question to both Chirag, to you and to Gaurav as well. Both of you are, Indians are generally risk averse, right? Like we don't like to take too many risks. So, when you have this risk averseness that we have, the fact that also we have this, demographic dividend, a younger population now getting into investing, the 2-3 years of COVID, that has been an interest when it's come to equities. Are you seeing demographically a different kind of investor emerge? Chirag, and any final thoughts that you might have on multi-asset strategies?
No, absolutely. Indians are risk averse, as you said, but invariably that risk aversion leads us to taking more risk rather than less risk. So when it comes to investing, I think investors are learning it the hard way. Many people went into direct investing into equities because they had some time, and lockdowns kind of led them towards that course. But they are learning it the hard way that SIPs or investing in mutual funds is a better route rather than going direct into equities. So if you look at the number of dormant accounts or inactive accounts have been increasing as opposed to what we were seeing as the big growth in equity demat accounts. So that really tells you, as well as at the same time, the SIP inflows into equity mutual funds has been increasing or has stayed constant. So overall, that tells you that, that is more an approach that people want to stay with as opposed to direct investing, because there are clear merits of investing through an expert like a mutual fund rather than doing it themselves. So that is one change that we are seeing. And as people become aware of mutual funds, they are looking at multi-asset strategies, how they can construct it for themselves, or be it using the solutions that mutual funds offer to invest and construct their overall portfolio. So I think there is more receptivity towards asset allocation. People are choosing not only two assets to invest, looking at 3 assets and looking at well-balanced portfolios to construct. So overall, I think as India moves into investing in a bigger way, as incomes increase, as you said, we will see more receptivity of mutual funds and more receptivity asset allocation as we go forward.
All right. Gaurav, you have the final word of this.
I'll just say 2 things, right? First, the first part, I completely agree with Chirag, right? So I think, and this is not the first time we are seeing this. Every time demat account explodes, everyone thinks, oh my God, what world's about to change. 2000, same thing happened. 2008, same thing happened. You have 2 really good years and people start opening demat accounts and everyone thinks that, they can make 30% every month. Of course, you can't. The realization comes in a year, it comes in 2 years, and then a lot of those accounts don't go dormant, or they move to, if they've really learned their experience, they will move to something like an ETF or a mutual fund and have a smaller portion of their portfolio, which they use to bet on stocks, but a larger portion would be on a goal-based plan or on a long-term investing plan with equity funds or multi-asset funds, right? The second thing about multi-asset funds in particular that I always say is I think people, and I know, Chirag, what's the easiest way to get this message across, right? The tax benefit that you have of doing asset allocation through a multi-asset fund is just incredible. It's just incredible. A multi-asset fund can rotate between debt and equity tax-free. No STCG, no LTCG, none of that stuff. Even if you're really good at portfolio allocation and you were doing it on your own portfolio, your every rebalancing is going to be a tax incident on you. So, and I would think, I've never done the math around it. I don't know, Chirag, if you have any numbers, but that itself would be 1.5 to 2% a year that you can get by just sticking. It's the same argument on why someone should not build their own stock portfolio versus investing through a mutual fund, because you build your own stock portfolio, every time you rebalance, it's a tax incidence and it eats up on your returns. Taxes are the biggest costs on your investment, long-term investment returns. And it's a very hard concept for a lot of people to get to, but I think it's the most important concept when it comes to multi-asset mutual funds, that if people can get that part, that, hey, you know what, I can do all of this myself, but even if I can do all of this myself, I should still go through a structure which is tax beneficial. And this is not expected returns. This is not saying the expert is going to get you better return. This is the structural benefit that mutual funds have in this country, and people should take advantage of it.
All right, that sounds like a good strategy. The only question I would again have is that, how do you then pick that right mutual fund, for yourself, and how would you go about selecting that one, and then of course keeping an eye on it and deciding, okay, this has run its course, I need to now sort of maybe move out of it.
See, there's a simplistic strategy and there's an advanced strategy, right? The simplistic strategy is to look at a multi-asset index fund of fund with, say, static allocations, right? That should be your entry point into, I think that should be the entry point for anyone who wants to start investing, right? It's a really simple concept. The rebalancing is predetermined. You don't take any market timing risk, because, even though an expert is deciding which asset class to overweight and which asset class to underweight, even experts can go wrong, right? I mean, what they say in investing, if you have a 52% hit rate for 30 years, you're golden. So that's the edge you need. You don't need like a 70% hit rate, right? So that's the simplistic. But if you are a more advanced investor, you understand concepts like value, you understand concepts like momentum and growth, then you should look for a fund manager that has similar ethos as you do, because they will be investing in ways that you believe is right. It's again, the concept is always that the investor preference and the vehicle preference should match. If I'm a value investor and you sell me a momentum product, even though momentum long term makes money, as a value investor, I'll find very hard to just hold that investment. I'll just be looking for reasons to sell it, because I don't, right? So for more advanced investors, look for the right fund managers who have the same process, the same thinking, the same risk management in place that you align with, and go with them.
All right.
Chirag would probably add a lot more to this.
Yeah, I think if you look at investors, there is a risk appetite that each one can go with. So there are funds which will be a little risk averse from multi-asset standpoint. They will have controlled allocation ranges for equities and debt. Some will be very, very aggressive. So depending on what kind of investor they are, they could choose the multi-asset fund, because there is a plethora of offerings available from mutual funds, right from the most conservative to mid-conservative to the most aggressive. But when you choose a multi-asset fund, and please ensure it's not for the tax benefit that 65% and above equities offer in our portfolio. It is more about how well you control the risk and return that you can have. So it should offer, it should be truly balanced, and it should offer fund manager enough flexibility to maneuver depending on the views that they take. That is where they exercise a real judgment, and therefore be able to control your risk and get you the higher return that you're looking for. So wisely choose when it comes to the multi-asset strategies. Gaurav spoke about indexes, but again, indexes also have its own issues when it comes to, say, for example, indexes do not take into account corporate governance in a big way, right? Like an active fund manager would do. So from that perspective, because it weighs companies based on market cap, the bigger you are, the more the chance of you getting included in the index is how the index is made. But when it comes to issues like corporate governance or any other issues that an active fund manager will be able to decipher, is not available with an indexing. So today, I think that's one of the big pillars that we believe in as investors, that corporate governance is essential. And therefore, we still think that active can provide you that shield against any corporate governance lapses that you can have in your portfolio. So overall, asset allocate, choose it very, very wisely.
All right, and I think that's a good note to end on. Chirag Mehta and Gaurav Rastogi, thank you so very much for joining us today and for sharing with us your thoughts and insights on asset allocation and asset management strategies.
Thanks, Milani.
Thank you, Milani.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.